Welcome back to our live cryptocurrency trading series. Today we're talking about the Forbes Fintech 50 and the companies in the cryptocurrency space that are listed there and what kind of trends for investors that might indicate. So, looking at the cryptocurrency markets today, pretty much all the coins, all the major coins in the red, though not dramatically. But it looks like that Fed meeting, that awesome Fed meeting in Washington, has somewhat slowed the hemorrhaging because cryptocurrencies across the board were down between 50 and 70% from this just barrage of bad news that just kept coming and coming over the last 6 weeks or so. Finally, federal regulators met in D.C., and that was an awesome meeting. If you haven't seen the video, look at the last blog post, and there's a link to it there. Watch it. I watched the whole 2-hour hearing. It's amazing. Chris Giancarlo, the chairman of the CFTC, opens the meeting by telling the story of how him and his wife tried to get the kids interested in investing, and they to no avail until Bitcoin came along. And now it's all that they talk about. So he started by saying we need to give this new technology some respect and a measured consideration. So it was a really a feel good meeting, and they the surprisingly for a change, the regulators, instead of being dismissive and talking about cryptocurrencies, you know, in terms of just you know completely dismissive terms, and uh, um, they actually showed that they had done their homework and made an effort to understand what's going on and connect with the new world of cryptocurrency. In the meeting, one of the most amazing things about the meeting was that Senator Warner, near the end of the meeting, said that if we continue the current rate of growth, cryptocurrency could be a $20 trillion entity by 2020. And that's true if you look at the math, and it's kind of amazing when you think about it. $20 trillion. I mean, now, it's in the $400 billion range right now as far as market cap, but the growth has been astonishing. So some of the things that came out of that meeting were that the feds really have that these guys from the government just actually sat there and talked about cryptocurrency for 2 hours. That alone is amazing. But what's really amazing is that they, astonishing really, is that they essentially talked about it as if it's not going away. Like they've decided that now this is a thing and we better figure out what to do with this thing because it's not going away. And the obtuse mischaracterizations of the past of typical financial regulators seem to have disappeared. So that meeting made a big difference, and the markets haven't rebounded dramatically, but at least the hemorrhaging has slowed somewhat. And you can see on the right of the chart here in the yellow circle, there's been somewhat of a rebound now. Ideally, for a turnaround of the trend, we'd like to see a higher low following a higher high. So this high right here didn't really make it to a higher high exactly. It made it about the same as the previous high. So, and then, so we have a higher low over here. Hopefully that will hold. But we'd like to see a higher high followed by a higher low, followed by another higher high somewhere up here, and that would be a good solid indicator of a trend change. But for now, at least we're in slightly negative territory for the day, but not horrible. And like I said, the feds of all people have somewhat staunched the hemorrhage. So the Forbes Fintech 50. What I did was break it down into categories because I wanted to talk about what types of companies made it into the from cryptocurrency niche, made it into the Forbes Fintech 50. And you've got wallets and storage, exchanges, mining, blockchain for finance, and enforcement. Enforcement being like this Chainalysis company, which already has the IRS, FBI, and Europol as users, and they track people online. So they're used by by governments and federal agents for enforcement. So I want to specifically look at the exchanges because uh, probably the typical standard model of exchange is not going to be the one that's going to last in cryptocurrency. And the reason I say that is because these exchanges serve as just massive bug bounties for hackers. Okay, there are funds concentrated, a lot of funds concentrated in one place under questionable security with, potentially lax or even corrupt management. So the idea that the exchanges are going to persist in their present form, that's probably not going to happen. So these were the two companies that made it to the Forbes Fintech 50, Coinbase and Shapeshift. And Shapeshift is an unconventional type of exchange, allowing trades between cryptocurrencies without an account or a wallet and not linked to a bank. So uh, and it charges no fees. It makes money on the spread. So it's an unconventional exchange, and I like unconventional exchanges because I think that typical model of the exchange, it leads to a lot of problems. And if you look back just recently over at the some of the problems that we've had with security, you can see that, for example, the CoinCheck hack, which was pretty recent, January 26th. Uh, over $500 million in NEM coin was stolen from the CoinCheck exchange, just because of a security flaw, just because of a simple fact that the private keys of customers that linked to their public addresses, allowing access to their coins, were not secured. You were not secured properly in cold storage, and they weren't secured properly, also protected with multi-signature verification. So the uh, the fact that security is not in the hands of the coin holder, that the security of the keys is not in the hands of the coin holder, is a huge problem with exchanges. And of course, hackers are going to target any place where there are a lot of funds that might be under lax security. So that's one issue, but that's not the only issue. Uh, the just recently, I think it was yesterday or a couple days ago, uh, there was this exchange, BitGrail, which lost $170 million of nano cryptocurrency, and that's not a small amount of money either. 170 million. And here's what one user explained: there was a bug on BitGrail where if you placed two orders, you got a double balance added to your account, and then you could withdraw the money while the orders were up and steal the coins. Now you'd end up with a negative balance on your account in the end, but you could just make a new account. So it was a bug on the actual exchange itself, not the coin and not the security of the exchange, but a bug in the exchange code. So, and this article from Bitcoin.com said bad code, it's an estimate, obviously. Bad code has lost $500 million of cryptocurrency in under a year. So if you look at the numbers, you're talking about bad code has lost as much as CoinCheck lost with a security flaw. This is just sloppy coding, losing actually that much. So this was a CNBC story, said massive Japanese cryptocurrency hack won't be the last. So I think that all of this news basically points to a very important truth about the future of cryptocurrency, and that is that conventional exchanges are not going to be the ultimate solution to trading. And I think that decentralized trading will mitigate a lot of these issues, if not solve that. It might solve some of them, but at least mitigate some others. Decentralized trading will obviously make a big difference in security, because if you store your own keys, then you have control over the security of those keys. And this is, let's see, Shapeshift, uh, you know, that made the Forbes Fintech 50 list. It says here, an unusual proof of concept, when Shapeshift was hacked by a malicious employee, no crypto was lost, since it doesn't actually hold customer funds. So that's the kind of structure that is probably going to dominate in the future of cryptocurrency exchanges, not the standard centralized exchange. But there's other ways to accomplish decentralized trading, and one of those is cross-chain atomic swaps, and that is trading without a centralized intermediary, without an exchange. And basically, it's done with a layer of nodes laid over the blockchain. So it's not part of the blockchain. And I'll show you what that looks like. This is a snapshot of the Lightning Network. This is not a blockchain. These nodes aren't nodes on the blockchain. This is a layer of nodes on top of or separate from the blockchain. And each node connects to multiple other nodes. And you can see, like, when I move one around, the ones that it's connected to will move also. And there's primary and secondary connections, and the primary, and tertiary, etc. And the primary connections move faster than the secondary or tertiary. But this is what the Lightning Network looks like. And what you can do, these are private channels. Private channels between nodes governed by smart contracts. And the smart contracts have a special type of structure that is referred to as a hash time locked contract. It's a type of smart contract that it basically it allows for two parties with no mutual trust to transact without having to trust each other. It uses a cryptographic algorithm that only allows users to access their funds once both parties have signed off on the duties of their respective transactions. And the algorithm, you can find it on this this Bitcoin wiki site, but it's a little bit complicated. But it basically says that one person sends the funds from their blockchain through the through the network of nodes to the other party, and then based on the hash time locked contract, the funds are only released. The second party then sends their transaction through the private channel to the first party using the same hash. And when the first party essentially opens their safe with their key, the same key is revealed to the second party, who then opens their safe with their key. And that's pretty much how, in a schematic sense, how the hashed time-locked contract works. So it allows for trading without a centralized intermediary, and it can mitigate several of the problems that blockchain faces right now, not the least of which security, really being the big one where money is concentrated on exchanges. So looking at the Forbes Fintech 50, you can see that we've got wallets and storage, exchanges, mining, blockchain for finance, and enforcement, and exchanges being a big one as far as investors. Coinbase made the list, but remember, Coinbase it's very popular in part because it is so easy to use. It's kind of an on-ramp, it's cryptocurrency 101 for beginners, and it is it's the largest exchange in the U.S., the largest exchange uh, in the world is actually, uh, well, blockchain is a wallet, is the largest or most popular cryptocurrency wallet. Um, but now it allows crypto trading in 22 states, including California. So blockchain is also getting pretty big. But as far as the future of exchanges, I think that deregulation, deregulated, decentralized trading will be dominant in the future. So therefore, I would say that if you're looking to invest in cryptocurrency exchanges, the smartest way is to look at, I'll just go to the analytics site here, and let's narrow these are all the coins. Let's narrow these down to just exchanges. I'll pick a category here, pick exchange. Okay, so and in looking at the exchanges, what I would look at is exchange platforms that are developing decentralized trading, because I think decentralized trading, because of the problems of centralized exchanges, will become the future of cryptocurrency trading. And hopefully this video has given you some important, useful, powerful information that you can put to use to make better, more informed, more research-based cryptocurrency investment decisions. Ciao for now.